Morning, everyone. There was a few questions about the tax structures, so I thought I'd go through a quick video this morning, just addressing some of it. There's 4 primary tax structures used in Australia for managing wealth generally. This is just general advice, and please talk to your accountant or your financial advisor, but at least it's a little bit more information so you know what you're going to ask. There's first one is a superannuation fund or self-managed super fund. This is for you to only touch when you're over 60 or 65, depending on your circumstances. If you're employed, 12% will go in from your employer and up to 27.5% can go, 27,500 can go in from like a business, and you could match that if you're 2 spouses. And it's a tax deduction, basically. The next structure would be a family trust. Generally, they're used for income splitting, especially if you're self-employed and if you have like a husband or wife and a children situation, no beneficiaries. They do have to be over 18 and they do need a tax file number, the children. It can be used to invest for assets, real estate, shares, bonds, and then you split the dividends at the end of the financial year or investment returns to help reduce the tax. It also provides some estate planning. So if your house is bought in a family trust, then to one of a better word, when we die, it'll just get handed down to the kids. There's no need to sell, or you don't go through a lot of red tape. Makes things a little bit more smoother in that transition and should avoid tax as well. The third structure is a company. Often you'll have companies and trusts working together. They're often usually, a business where you're selling a product or a service, and then they can be used on small scales to manage wealth and investments as a business. The corporate tax rates are generally lower than the marginal tax rate. So the highest tax rate in Australia is 47%. Company tax gets flat rate at 30%. So if you're in that next tax bracket, it would make more sense to then structure a company, especially compared to like a sole trader and other business structures like that. The fourth one, is investment bonds or education bonds. So they generally operate on the same company tax rate of 30% as well. They've got special rules, including a 10-year rule and 125% contribution to the limit on tax year, but they're really good if you have private school fees and they can make it into a tax deduction. They can be really useful when used right. At the end of the day, it's the first step of financial planning to be managing your money in the right way, maximising it basically. And then you decide on where you want to invest your money, shares, your shares, bonds, cash, whatever might be right for you and your family at the time. But anyway, hope that helps. And